I have a question I want you to actually sit with for a second. If your marriage ended tomorrow, do you know your own individual credit score? Not your household's, not the number your spouse sees on a joint account. Yours. Consider a woman we'll call Starting Over Susan. She's 49 years old, coming out of a 23-year marriage. For 2 decades, she paid the household bills on time and never overspent. Yet, sitting across from a loan officer 8 months after her divorce was finalized, she was denied a basic apartment. She discovered her individual credit score was barely above 600. This diagram shows exactly how that happens. When 2 people marry, their distinct financial identities often merge into a single household entity. But when the marriage legally ends and that household splits apart, the lower-earning partner often finds their circle is empty. Their independent paper trail simply doesn't exist. And when that empty circle drops onto a timeline, the math problem becomes severe. A divorce in your 20s leaves decades to recover lost ground. A divorce at 49 leaves a sharply compressed runway before retirement. You are starting from zero right when you have the least amount of time to rebuild. A long marriage intertwines 2 lives, but it frequently erases the lower-earning partner's financial history entirely. This erasure rarely happens out of malice or financial abuse. It happens because traditional family organization naturally consolidates paperwork. Decisions compound invisibly over decades. One partner pauses their career for childcare. The primary credit cards go under the highest earner's name. The family's wealth accumulates in a retirement account attached to one person's employer. We end up with a severe disconnect. The legal system views marriage as shared property, but the banking system strictly expects individual credit. A judge will happily sign a divorce decree dividing that shared property, but that piece of paper does absolutely nothing to automatically grant you an individual credit history. Bridging the gap between the assets you are legally owed and the credit you can actually leverage requires you to proactively decouple from the ex-spouse's financial profile. The first move is establishing your own credit profile immediately. You have to open new accounts entirely in your name and sever any remaining joint accounts. Watch this line graph of 2 connected credit scores to see why. If your ex-spouse controls an open joint account and makes a single late payment, a shockwave travels down that tether and actively destroys your independent credit score, even after the divorce is finalized. The second intervention involves extracting the actual wealth accumulated during the marriage, specifically from retirement accounts. People often assume that dividing a retirement fund works the same way as splitting a joint checking account. They try to simply withdraw half the money and move it over. Attempting a direct split instantly spawns aggressive tax and penalty subtractions that consume a massive portion of the money. To prevent that, you need a specific legal document from the court. This shield deflects those penalties, allowing the asset to divide cleanly and remain whole. Walking out of a courtroom without understanding those specific legal mechanics turns a fair settlement into a real-world financial disaster. The third step is completely administrative, which is exactly why it constantly gets overlooked. You must update the beneficiary designations on your life insurance and retirement plans. People assume a legal divorce decree automatically overrides the original paperwork held by the financial institution. It doesn't. If you don't file new forms, your ex-spouse remains the legal beneficiary of those accounts. Which brings us back to Susan's empty paper trail. Could she have avoided finding herself invisible to the banking system at 49? Yes, and doing so wouldn't have required her to constantly distrust her husband or anticipate a divorce for 2 decades. Opening a credit card in your own name, paying it from your own account, and maintaining a separate financial history isn't a backup plan for a failed marriage. It is a baseline requirement for functioning in the modern economy. Actively managing your own paper trail is the only way to ensure your legal reality matches your lived reality. It protects your independence, whether your marriage lasts a lifetime or ends tomorrow. If your marriage ended tomorrow, do you know your exact individual credit score? Not your household's or a joint account, yours. Ending a marriage in your 20s or 30s leaves you with time. You have decades of working years ahead to rebuild a financial foundation, restart a career, and recover lost ground. Ending a marriage after 20 years, in your 40s or 50s, presents a much harsher math problem. The clock is significantly shorter. By that point, you've made decades of financial decisions together. One person might have paused a career to raise children, while the other might have managed the investments. Over 20 years, those asymmetrical choices compound, creating a severely uneven starting point the exact moment the legal paperwork is signed. Untangling 20 years of intertwined finances requires confronting a cold mathematical reality, regardless of why the marriage ended. To see how this actually plays out, let's look at a case study. We'll call her Starting Over Susan. She's 49 years old and ending a 23-year marriage. She worked part-time to raise their children while her husband grew into the primary household earner. From the outside, their household finances looked bulletproof. They had a paid-down mortgage, consistent retirement savings, and paid their bills on time. Yet, 8 months after her divorce was finalized, Susan sat across from a loan officer to get approved for her own apartment, only to discover her individual credit score was hovering barely above 600. She hadn't been irresponsible, but virtually every major financial asset, credit card, and loan in her life existed as theirs, usually attached primarily to her husband's income and name. On paper, her individual financial footprint was practically non-existent. Traditional household financial structures systematically absorb a woman's individual financial identity. She operates as an equal partner for decades, only to find herself financially invisible at the exact moment she needs independence the most. This invisibility creates 3 specific financial traps. The first and most immediate danger comes from the accounts you already share. A joint account left open after a divorce is an active, ongoing liability connecting you to your former spouse. If your ex-spouse controls a joint credit card and misses a single payment or runs up a high balance, that behavior instantly damages your credit score. A judge signing a legal divorce decree does not automatically sever your financial liability with the banks. The only way to stop that exposure is to physically close or separate the accounts. The second and easily the most expensive trap is the assumption that dividing a marital retirement account works exactly like splitting a joint checking account. The default approach couples try is simple, but disastrous. The account holder withdraws half the balance from their 401k or pension as cash and hands it directly to their ex-spouse. This chart shows exactly why that fails. Taking a direct cash withdrawal triggers massive, immediate income taxes, plus an early withdrawal penalty. By the time that money reaches the second party, the total amount is immediately decimated by the IRS. To prevent this, you need a QDRO, a Qualified Domestic Relations Order. It acts as a specialized legal shield, allowing those retirement funds to transfer directly into your own account intact, completely bypassing that immediate tax hit. This trap catches people because a QDRO is entirely separate from your standard divorce decree. It requires specialized drafting that general divorce attorneys often overlook. Without that specific legal document drafted and approved by the plan administrator, a 50-50 retirement split on paper guarantees you walk away with a fraction of that value in reality. The third trap stems from prioritizing emotional attachments over math. Usually, this means fighting to keep the family house. This diagram shows the false equivalency of settlement assets. $1 in a Roth account, $1 in a traditional 401k, and $1 of home equity might look identical on a settlement sheet. But look at the actual after-tax and post-maintenance value. They are completely different assets. Keeping the home frequently forces you to trade away higher-yield, liquid retirement assets. It also leaves you solely responsible for property taxes, insurance, and maintenance, all on a single income. Accepting a divorce settlement based strictly on current surface-level balances, without calculating long-term tax liabilities and maintenance costs, guarantees a deeply unequal financial outcome. Susan's path forward required an internal change. After 23 years in a dynamic where she wasn't the primary manager, she had to stop treating financial oversight as a shared responsibility and start seeing it as her own individual right. She took immediate corrective action. She hired an attorney specializing specifically in QDROs to secure her retirement funds, and she aggressively opened new accounts entirely in her own name. That brings us to your tactical survival rules for the first year. Rule 1. You must close or separate all joint accounts immediately. Rule 2. If retirement funds are involved, demand a properly drafted QDRO. Rule 3. Update all beneficiary designations on your life insurance and existing accounts immediately. This is an urgent administrative fix, not a task for next year. Rule 4. Build an emergency fund that exceeds the standard 3 to 6 months of expenses. You need extra capital to absorb the extreme financial volatility of this transition period. Rule 5. Hire a brand new financial advisor, chosen specifically for your independent situation. Do not continue using the advisor who primarily served the marital household. A judge's signature provides the legal end to a marriage, but actual financial independence is the result of a deliberate, multi-front strategy. If you're currently in a happy marriage, this information still applies to you. Deliberately building your own individual financial footprint is not a sign of distrust in your relationship. Financial transparency and strong individual credit health are baseline protection mechanisms. They serve you regardless of how the next 50 years of your life unfold. Here is your 20-minute homework assignment for today. Pull your individual credit report and check for any live joint accounts. If you are navigating a divorce, ask your attorney directly about the status of a QDRO. The goal here is not to harbor regret over the financial dynamics of your marriage. The goal is to gain absolute clarity on the precise steps you need to take today to ensure your financial survival. If this gave you clarity, subscribe for unvarnished financial realities that mainstream advice often skips. And drop a comment telling me where you are in this process so I can tell you which part of this framework matters most for your situation right now.